As far as interest rates go, what are you seeing in the market today with seller expectations, buyer expectations? Is there still a delta between the two? Is everyone coming to terms with interest rates? Or are folks expecting rates to be elevated for a longer period of time? Or just what's your general sense?
I think last year, people were much more optimistic that rates would come down. Beginning of last year, all we heard were rates were going to come down Q3 of 23. They've got to come down. Well, they didn't. And so now I think people are cautiously optimistic this year. Okay, they're going to come down. I don't know if they're going to come down as much as what we had thought, but I think they've got to come down. So that's the consensus right now. In terms of the bid ask price, it depends on the asset. So that's another thing that we've really seen shift in 21 and even early 22. There was capital throwing money at multifamily. Inflation period, that was the craze that was post-COVID. Well, multifamily proved to be very resilient throughout that because, one, everyone needed a home. Well, if there's inflation, then rents will go up. And that's where we saw the 20% rent increase in Miami. That's where even St. Louis, we saw 8 to 10% in some of these Midwest markets. So you had a lot of capital chasing. And again, debt was very, very cheap. And you had multiple sources of debt. You had banks, you had bridge lenders who would lend on future values. And then you still had Fannie and Freddie who lend on in-place numbers. Well, when the rates changed and feds raised those in April of 22, the bridge lenders started to raise as well. The short-term 3-year money floating rate debt shot up. And a lot of them pulled back from the market. The ones that were still there went from lending at 3 to 4% to now 12%. And it just didn't make sense to go bridge debt. So one fortunate thing that the multifamily industry has is Fannie and Freddie. But as they always have, they're lending on in-place numbers. So there's not that lender right now that's out there unless you have a relationship with the regional local bank.
And deposits.
That are lending on future values and upside. So because of that, you've seen this shift towards quality, stabilized assets across the Midwest. We're still selling assets all across A, B, and C classes, but I would say the buyer pool is completely different.
There definitely was in 21 and parts of 22 a convergence in cap rates between C class, B class, and A class apartments. Did you see a lot of people trade between the asset classes at that time? Like maybe sell a C asset, go buy an A or a B?
Absolutely. The lowest cap rate that we've ever seen was one here in St. Louis that we sold, 200 units, built in the 60s. It was a legitimate 2.6 cap rate. And cap rates are becoming more and more subjective. What expenses are you looking at? Is it the seller's trailing expenses, which are light or they're heavy? Or are you using yours? Are you adjusting for taxes? Are you adjusting for insurance? So they're becoming more subjective, but on a true cap rate, that was the lowest that I've seen. And that is when groups, one, were able to buy with debt that would provide liquidity based on future values. So yes, they were buying at a 2.67 cap rate, but they were pushing to a 7+ yield on cost. Well, when the debt's that cheap, nearly free in the low 3s, it makes a lot of sense. Now, when that lender is gone, and which here we are today, it's really just Fannie and Freddie. If you wanted that same deal, the loan proceeds would be much, much lower. So the cap rate's going to be more in the upper 5s, maybe 6 cap range.
At that time, like for someone to buy a 2.6 whatever cap deal, were they betting on or banking on market-driven rent growth or just their own rent growth through renovations or something along those lines? And then also, were they factoring in the inflation in expenses, whether it's insurance, repair materials, whatever the case may be?
Good question. So a lot of those here in the Midwest were bought because of the upside within the unit renovations. Okay. So not so much appreciation. You look at a Dallas or Phoenix, cap rates were so low there because of the competitive nature that you could either go to Fannie and Freddie, but the loan amount's going to be this. Well, if pricing keeps going like this because of, and I'm giving hand gestures, forgetting we're on a podcast, but if
we got the video. So.
Yeah, so if pricing keeps increasing, the loan proceeds aren't. So then that forces a lot of buyers to go to a different direction. Well, that's when they would go to the bridge lenders, and the bridge lenders would lend as well on future values. And so a lot of the trades in the Dallas and Phoenixes were bought with bridge debt. The Midwest, we still had a lot of executions with Fannie and Freddie, unless they were value add purchases where they would go in, renovate, and push rents, not organically, but through renovations.